Welcome to EIS Navigator, the podcast for UK venture capital. I'm your host, Brian Moretta. Today, we are starting something different for the podcast. This is the first episode in a series of EIS Navigator Basics. We had some feedback from listeners that they wanted a bit more introductory material. So for the next sort of 10 weeks, hopefully, we will be having shorter episodes, which will focus on some basic topics and introducing various things about EIS VCTs and investing in them. We're doing these on audio and video. So if you want to see our lovely faces, you can see us on YouTube as well. So you can subscribe to that as well. So for the very first episode, I'm delighted to be joined by Nic Pillow, who is Ventures Director at Blackfinch Ventures. Welcome to podcast, Nic.
Thank you. Hello, Brian.
You might want to tell us a little bit about who Blackfinch are, so we have a little bit of context for why we have asked you on.
So Blackfinch is a multi-asset investment specialist based in Gloucester with over £900 million assets under management. And I'm part of the ventures team, which was established about 6 years ago. I've been in there almost from the start since when we've deployed about £100 million with our EIS portfolios and our venture capital trust.
So today's topic, starting at the very beginning, is going to introduce the Enterprise Investment Scheme, which is generally abbreviated to EIS. So that's what we mean when we say EIS. So Nic, maybe do you want to start by telling us what is the aim of the Enterprise Investment Scheme?
Yeah, so the government set up the Enterprise Investment Scheme over 30 years ago now with the intention of getting funding into new businesses to help them get established, the future businesses of the economy. And the really good thing is that they didn't say, right, we want money to go into these businesses. Let's get lots of civil servants to pick the companies that we think are going to be the winners. They set it up instead as the tax incentives to encourage private investment to go into these very early stage, very high risk investments. And from their point of view, it's obviously good for the economy, but it's very good for tax receipts as well. They're giving away all these tax breaks to investors, but they get back in return lots of employment. The companies that do well do really well. They give you company tax as well. So it's actually worked out really well for the government, which is why it's run for quite so long. So from an investor point of view, what's the point? The point is you gain exposure to a different asset class. You can invest in something which is higher risk than you normally would because it is offset by those tax reliefs. And it's great diversification. Brian, I know you've done some great work in how a whole portfolio can be better diversified with some EIS investment. From a government point of view, it's all about getting money into new companies. And for that reason, it's only applicable for new share issues. It's not for investors to then buy up somebody else's shares in a company. It's where a company is raising money because they need to invest to develop their future.
The statistics show it's been fairly successful. That I think in terms of generating new companies and jobs. It has definitely worked. So in terms of types of companies, you mentioned about high growth. I think there's a variety of things that we see getting funding, but in terms of sort of the funds market in particular, do you want to tell us about what we mean by because we're going to talk about venture capital as well, and I think that's got certain characteristics that maybe people may or may not be aware of.
Again, thinking from the government point of view, the main point is it has to be risk involved. You get the tax reliefs to compensate for the risk. And so the expression is capital at risk. And we've all seen that with various investments, but it really is the case with EIS ones. You can't invest in a business like, property development where there's a big asset and it's like, well, if it doesn't quite work out, well, we can just sell it anyway. That's not risking your capital. The government says, no, you've got to have this. This is the underlying condition. And they exclude certain sectors as well. You can't do farming, for example, or, accountancy services or financial trading. Otherwise, it is a really broad range of the types of companies it can support. I mean, just to give some examples, and we've just invested in a company called Space Flux, which is monitoring objects in space. around the Earth, satellites, but also, debris as small as 2.5 centimeters. And it's got this network of telescopes and some amazing technology that's tracking all these for the benefit of governments and satellite operators. But then equally, we've got a company that helps older people. So it's Good Life Sorted, and it helps arrange people to come into the homes of elderly people, not to care for them, but just to do things like the shopping, the cleaning, talk to them. Very, very different type of business. Or again, one of our earliest investments, a company called Spotless Water, that provides pure water for window cleaners around the country. I had no idea this was a thing. One of the beauties of my job is getting to see the amazing different things that there's actually a need for in the world. And so Spotless Water's got these self-service dispensing stations around the country in various car parks and so on, where window cleaners can just pitch up and fill their vans with ultra pure water, which is what they use to clean windows. So this huge range of businesses, but all meeting that condition of the capital being at risk.
Yeah, and you mentioned the history, and I think maybe I would say that was introduced, I think, in 2019, and that sort of risk capital condition. And prior to then, there were other sort of businesses that you could invest in, but I think it's one of those changes the government made that has really worked well, and I think it's been very appropriate, and money has definitely gone towards the sort of things the government wants. But the government is also focused on one area in particular, and there is this thing called a knowledge intensive company. Do you maybe want to say what that is and why the government's so interested in them?
Yeah, well, I think reasonably the government sees the future as being in businesses that are actually innovating. They are, if you like, in the sense creating knowledge, or what we would typically call intellectual property. And a classic example would be another of our recent investments, a company in Scotland called Neuranics, which is a university spin out, creating these incredibly sensitive magnetic sensors that you can wear. It's the most sensitive wearable magnetic sensor. A huge amount of knowledge in there and being created, but it is much broader than that. You don't have to be creating patents. You could just be, for example, writing software. And what's important is you are creating that software and then you are selling it. So your business is based on what you created. You are not reselling somebody else's software. It's what you've created. Maybe you don't want to go into too many of the technical details, but HMRC, of course, has tests to prove that companies qualify as being knowledge intensive, because then they get more, they get better conditions. And basically, you have to spend enough on research and development. And it doesn't have to be the pure research. It can be that simple development of a product. And you have to expect the majority of your business to come from intellectual property. I'm simplifying again slightly, but that's broadly what it means.
They can do applied technology in a sense rather than doing fundamental original research.
Yes, and in fact, most of our companies, because we are broadly a tech investor, most of our companies would qualify if they needed to. But it's one of those things where you don't go to HMRC unless you need to get the confirmation.
Yeah. So as you mentioned, the government does have various rules and they are keen to stop abuse, I think would be fair, and very reasonably so, because you don't want any random company just supplying a person getting it. So a couple of these things pertain to size, and I think these are quite useful. So can you give us an idea of sort of what restrictions the government places on company size for this?
Yes, it is intended for smaller companies, but in terms of employees, they have quite a generous limit. There's 250 employees is the standard limit. You can't be more than that unless you're knowledge intensive, in which case it's 500 employees. But most companies these days have quite small workforces. Although interestingly, we've come across that restriction recently with one of our companies called Teamed. It's what's called an employer of record. If you want to hire someone in another country, but you don't want to create a subsidiary in that country, then you can use Teamed, who will employ that person for you, and then you pay Teamed, and they handle all the local benefits and HR and payroll and all the rest of it. Really, flexible solution for companies in this day and age. But unfortunately, they've now crossed the threshold of 250 employees because they're employing people on behalf of all these other companies, their customers, and that does count. It wasn't quite the intention of the rules, but they get caught by it. So there's an employee limit. There's also an assets limit. You can't have more than £15 million of assets before the investment. And you can't raise more than a certain amount of investment in 12 months or in your lifetime, because it is intended for these small companies that are getting going.
Yeah. And we will post a link in the show notes, which has the details, the numbers, if people actually want to read further on that.
Worth mentioning as well the age test, because that is the one that catches more out than anything else. And again, it's supposed to be for new companies. The theory is that a company that's been running for many years can fund its own research and development and invest in its own future. It's not always quite so simple in practice, but normally you would need to be no more than 7 years old to be able to take EIS investment.
And the 7 years, I think, is defined as since your first revenue.
It's defined as since the first commercial sale. And you're allowed to have things like test sales and some pilots and things. You obviously have to be a little bit careful about how you define that. And if you're knowledge intensive, it's 10 years and there's a different starting point, but that's maybe too much detail.
Yeah. But yeah, I think it's worth saying, you're right to highlight that. And I think it's also worth saying that amongst investors, it's perhaps the most controversial rule. I think it's the one that feels most arbitrary in some ways.
And we certainly see companies that are creating, technology, and it can take quite a long time for it to get going. And why do you say just because it's taken you more than 7 years to get to this point where it's really viable, you can't then take EIS or VCT money because the same rules apply there?
So if people are sitting there and saying, this sounds fantastic, how to invest, what's the kind of options for them to find EIS companies to invest in?
So EIS is very much a scheme designed around investing into specific individual companies. So you would always end up knowing, however you've invested, I've got, the right to shares in certain companies. And you can, of course, just, talk to a company directly if you've got the resources to do angel investing at scale. Talk to founders, and they sort out most of the paperwork. So it's not onerous to do from that point. You just have to pay them lots of money. If you're getting going, it can be better to do that as part of a syndicate. There are angel syndicates who then will collectively review, and you can talk with other investors about what might or might not be, good investments to make. And obviously, you can pool your investments to have a bigger impact. At a smaller scale, you could just go onto the crowdfunding sites. Forget the names of them these days; they keep changing their names. And
Crowdcube, I think.
Yes. Then you can put tiny amounts on then. And if you're interested in starting, then it's worth having a look at them just to say, okay, if I were to put some money in, what would I pick? Or maybe get together with a couple of friends and say, right, we're going to put £10 each into a company. Which one are we going to pick? And it really makes you think about what makes a good company to invest in and whatnot. The things I would say about that, though, are diversification. These are all high risk investments. Don't just put your money into one because it sounds like a good idea. You need to do this at scale across many companies. The easiest way around that is to invest in a fund. I say fund in a loose sense because, as I say, you will end up with shares in individual companies, and there are slightly different technical structures. But in our case, for example, if you put some money into the Blackfinch EIS portfolios, we would invest those funds into at least 10 companies. We would aim to do that in 12 months, usually by the end of the tax year. Then you would end up with that portfolio, but it wouldn't be suddenly, oh, right, well, we've got these investments sitting on the shelf and suddenly you've got shares in this company. It takes time because we need to then deploy the funds into companies you can't buy into an existing fund.
And I think there's two models in a sense. So there are other people who operate very much on a tranche basis. So if you invest by a certain date, you will get wherever the portfolio is on that date. And there are others who, a bit more closely, invest over a period of time, and you will get the next, you'll participate in the next 8, 10, 12, whatever it is, 4 deals.
Yeah, so we can, as standard, we would do it over 12 months, but the reality is most investors choose to have all their funds invested by the end of the tax year. And so That's what we do. And the final thing I would say about investing in it is a check for EIS advance assurance. And that will then be like HMRC saying, yes, we've looked at the details of this company, at least the ones they've sent to us, and we agree it is eligible for EIS, because there are, of course, companies that aren't for whatever reason, including that age test.
Yeah. And that is not foolproof, because between it being issued and you investing, things can change in companies as well. So let's always be aware of that. I think the final question I want to ask is, what we haven't perhaps talked about is the illiquidity of the investments, because there is this rule about, while you can do some things today, most of the companies are unquoted, and the rules suggest you should hold for 3 years. Is that a realistic time, do you think?
Well, 3 years is the time you have to hold the investment if you want to retain your tax reliefs. We haven't talked about the tax reliefs. They are very nice. I know you're talking about those in a separate session. So you have to hold for 3 years. However, two things as a however. First of all, any company like this, it's a long-term investment. It's not going to develop necessarily as quickly as you or the founders at point of investment would expect. You have to be prepared to hang on for the long term. And the second thing related to that is, it's not your choice when you come out. You can't say, right, I want to hold this for 4 years and then I'm going to sell it. You can't decide after 4 years, right, I want to sell it, because almost certainly there will be no market for the shares. We said at the start that you can only get EIS tax reliefs for new issue shares. So what's the incentive for someone to buy the shares off you? They don't get the tax reliefs. So it's very unlikely that you're going to be able to sell them. You have to wait for the company to be sold, possibly to list on an exchange, or again, very possibly raise a huge round later on in the future from a big investor who wants to clear out some of the existing early investors to get a smaller set of investors. And yeah, that's not your choice. It's not our choice as an institutional investor either. We're only ever able to take a minority stake in businesses, so we're not controlling the company. And yeah, you just got to hang on until it happens. And if you invest in 10 companies, they're all going to exit at different times. So you can expect the funds coming back, very likely, different times. It might be you get one in 3 years and you have to give your tax reliefs back. Hopefully that only happens if you're making a very good return very quickly. It's more likely it will take quite a lot longer. Our target holding period is between 4 and 7 years, but we're very clear it can take longer.
I suggest to people, you think about this as a decade-long investment. That's, because by the time you get the latest one, even in a portfolio, you may average in that time scale you talk about, but things can easily take longer depending on the market goes. I'd like to thank you very much, Nic, for coming on and talking about these things today. Being our very first guest on the Basic series, we really appreciate you coming on. For listeners or viewers that I've got today now, as usual, you can get full show notes with links at hardmanco.com/podcast. You can, of course, find us on YouTube or good podcast players. If you liked what you're hearing, then please tell a friend or a colleague. Give us a review on your favorite podcast app. Give us a thumbs up on YouTube. It's at hardmanco.com. Thanks for listening and watching, and we'll be back with an episode on the tax release, as Nic alluded to, next week.